30-second stock. Let's go. Hey, in this video, I want to outline a trading strategy that I like to use. I look for growth stocks that are undervalued after an earnings report, and I buy them as if they're value stocks. I'm going to walk you through what I like to look for and show you two examples of how I made 20% in under 2 weeks. Value investing is finding a company that's trading at a low price relative to its fundamentals. If you need a refresher on fundamentals, I have quick metrics videos that will walk you through market cap, PE ratio, and other fundamentals. Warren Buffett is the most prolific value investor. So what's a growth stock then? These are companies that have a fast rate of growth, like a software or tech company. They will be relatively correctly valued or overvalued. Investors are buying the rate of growth at these companies and not the underlying fundamentals. Publicly traded companies are going to report their earnings every quarter. Sometimes the stocks will jump up, sometimes they'll go down. It really depends on how the company performed in the prior quarter compared to their forecasts and what their forward earnings forecast looks like or changes to. If a company revises their forward earnings down, that stock price will likely decrease. If current period customer count is down compared to forecasts, the stock price will also likely decrease. The same could be said of the inverse. You want to understand the impact of what happened and what the company thinks will happen before you take a position. Buying bad news is normally called trying to catch a falling knife. You want the knife to touch the floor before you try to grab it. You don't want to get cut by the blade. You may have been told to wait 3 days before buying a stock that has had a large price decrease. That's because of this adage. There is a chance, though, depending on what was said in the earnings report, stocks that have fallen dramatically do not necessarily need to go back to their previous price, especially if forward guidance has changed. Bad news can be bad news, but sometimes bad news isn't actually bad news. Let's take a look at Roku. Roku's Q2 2022 earnings saw their share price go from $85 down to $65. What changed? Sales volume was down, and that scared investors. However, the outlook for the rest of the year remained the same. Remember, Q2 of 2022 had strong consumer spending, and jobs reports were also very strong. Also, I bought a Roku during this time, so taking all that into account, this bad news didn't feel like bad news. So I bought progressively through that first day, and you can also see my cash position was relatively low. I did that for risk mitigation. Also, I was using a long-term trading account where I don't have a lot of available cash. You can see I held that for 5 days and I sold it for a 24.8% profit. I don't know that there was any exit strategy necessarily. I wanted to use the money for a different investment. I do like to take profit though. Next up is TWLO. This trade is more recent. This is on Q2 23 earnings. Sort of a similar situation, TWLO missed sales guidance. They did not lose any key clients. This is big for their industry specifically. And their 2023 outlook remained strong. This was only a few months ago, but if you remember, the terminal rate for the Fed was the dialogue in the markets. That just means that a lot of investors thought we were at the end or nearing the end of the rate hike cycle. Similar situation, I didn't invest a lot of money into this play, and I dollar cost averaged, which I didn't do with Roku. But you can see it worked out. Over a 12-day period, I made 20.1% on TWLO. I've been watching this company for a long time and I've owned shares at different times. I believe in what they're doing. I currently don't own any shares of it though. So I think the biggest component here is you want to make sure that when you do this, you're not catching a falling knife. What does that mean? It means analyzing the earnings report and understanding where the company thinks it's going to go. I think understanding the trends of the company specifically are really important too. If you knew that TWLO used to be at $250 and now it's at $60, your investment strategy might be different knowing that. And then obviously the biggest one, market sentiment. Understanding how the market feels about the economy is very important. People looking for large returns are going to ask the question, why not options? Why did you buy shares? I used the chart from my TWLO trade here to explain why I did not buy options. The red box on the chart is showing a 10-day period after TWLO's stock price dropped. When stocks have large fluctuations in prices, the implied volatility pricing of the option will increase. So buying a call at the low point here on TWLO would really have been a double whammy. You would have got hit by decreasing implied volatility and got hit by theta decay over a 10-day period. I like to make money, so that's why I didn't buy options on the day of the earnings drop. Thanks for sticking with me. I'm going to give you my final thoughts on this trading strategy. There are opportunities for value plays on growth stocks. Of course, there are risks. Sometimes bad news is bad news. But if you understand the specific stocks trends that you're looking at and what the market sentiment is today, you have the potential to make some profit. I hope this helps as we enter into our next earnings season. Please subscribe to see weekly fast analysis of my stock picks. I want to give a shout out to Jelly Bean Capital. Thank you so much for watching. We'll see you next time.